Before the Great Fall, there was an incredible climb. Imagine a time in America, the 1920s, when it felt like the party would never end. We called it the Roaring Twenties for a reason. World War I was over, a distant memory, and the country was brimming with a kind of infectious energy. New inventions were changing daily life in ways that seemed almost magical. Radios brought the world into living rooms, automobiles gave families the freedom to explore, skyscrapers reached for the heavens. It was a decade of jazz, flappers, and a deep, unshakable belief that prosperity was an American birthright. The future wasn't just bright, it was blinding. This feeling of endless possibility wasn't just in the air, it was in people's pockets. Factories were churning out goods at an astonishing rate. For the first time, many ordinary families had a little extra money. They could buy a new Ford Model T, a refrigerator, a washing machine. Things that had once been luxuries for the wealthy were now becoming staples of middle-class life. This new consumer culture fueled the economy. At the heart of this national optimism was a place called Wall Street. The stock market, once the exclusive domain of bankers and industrialists, began to capture the public's imagination. So, how did so many ordinary people jump into the complex world of stocks? It happened through a simple but dangerous idea called buying on margin. Think of it like this. You only had to put down a small part of the stock's price, maybe just 10%. For example, $100 of stock required only $10 of your own cash. Tempting. Potential profits could be multiplied tenfold. Suddenly, you didn't need to be rich to invest, just a little cash and a lot of faith. Buying on margin poured fuel on a roaring fire. More people borrowed to buy stocks, demand skyrocketed, prices rose. A self-fulfilling prophecy. Prices rose fast. It seemed foolproof. Buy on margin, wait for the price to climb, then sell, pay back the loan, pocket a profit. It seemed like free money, drawing millions into the market, but it was built on debt. The cash pushing the market up was borrowed, not saved. Brokers' loans grew from under $4 billion to over $8 billion by fall 1929. The market stopped reflecting company value. It became a mountain of speculation, investors stacked on investors, held up by a web of loans. Few noticed or cared. Bankers, brokers made fortunes on interest. Investors were mesmerized by the ticker tape. A few cautious voices warned the boom was unsustainable. Prices detached from reality. But they were ignored, dismissed as pessimists. In the Roaring Twenties rush, the idea prices could fall as fast as they rose seemed impossible. By the autumn of 1929, the market had reached a breathtaking peak. But beneath the surface, the American economy was showing signs of strain. The great boom in construction was slowing down. Industrial production was beginning to dip. Farmers had been struggling for years. The massive wealth of the stock market hadn't trickled down to everyone. A huge portion of the nation's riches was concentrated in the hands of a very few. Consumer spending that had fueled the boom was starting to weaken. People simply couldn't afford to keep buying all the goods that factories were producing. The foundation was cracking. The first major jolt came on Thursday, October 24, 1929. Black Thursday. The market opened with a sudden and terrifying wave of selling. Prices plunged. The confident roar of the trading floor turned into a chorus of panic. Crowds gathered outside the New York Stock Exchange on Wall Street, faces filled with anxiety. Inside, the ticker tape couldn't keep up with the sheer volume of trades running hours behind. It felt as if the floor had dropped out from under the entire country. In a moment of high drama, a group of the nation's most powerful bankers stepped in to stop the bleeding. Charles Mitchell of National City Bank, Thomas Lamont, head of J.P. Morgan and Company. They met in the afternoon. They decided to pool their resources and make a very public show of buying huge blocks of stock. Major companies like U.S. Steel. Their goal was simple: restore confidence. For a brief moment, it seemed to work. The market rallied and recovered some of its losses by the end of the day. A sense of fragile relief settled over the city. The fragile calm that had settled over the weekend was shattered on Monday, October 28th. The selling started again, this time with even greater force. The bankers, who had been hailed as saviors just days before, did not intervene. They had already spent vast sums and realized they couldn't hold back the tide. The market dropped by a staggering 13%, a loss that totally dwarfed the initial panic of Black Thursday. The optimism that had defined a decade was evaporating in a matter of hours. Then came the day that would live in infamy. Black Tuesday, October 29, 1929, it was the day the bottom truly fell out. From the opening bell, a tidal wave of sell orders flooded the exchange. Everyone wanted out, all at once. The system simply broke down. A record-shattering 16 million shares were traded as people desperately tried to sell their stocks at any price. But there were hardly any buyers. Prices collapsed in a free fall. Fortunes that had taken years to build were wiped out in a single afternoon. The ticker tape ran so far behind that people had no idea how much they had lost until hours later. It was, honestly, a scene of absolute and utter financial carnage. The impact on individuals was swift and brutal. For those who had bought on margin, the crash was a complete catastrophe. When the margin calls came, they had to pay up. But the stocks they owned were now worth just a fraction of what they had paid for them. To cover their debts, they had to sell everything they owned: their homes, their cars, their life savings. Stories emerged of millionaires becoming paupers overnight. But it wasn't just the rich who were hurt. Millions of ordinary Americans who had put their small savings into the market, dreaming of a better future, were wiped out completely. The money they had been counting on for retirement or their children's education was simply gone. The psychological shock was as profound as the financial one. The crash shattered the nation's confidence. The belief in American ingenuity and endless growth was replaced by a deep and gnawing fear. People who had felt secure just weeks before were now terrified of the future. The very institutions they had been told to trust, the banks, the stock market, the business leaders, had failed them. The Roaring Twenties had come to a sudden and violent end, and as the dust settled on Wall Street, a long, dark shadow began to spread across the land. The Great Crash was over, but the Great Depression was just beginning. The 1929 crash was more than just a financial event. It was a turning point in American history. As the stock market collapse spiraled into the Great Depression, the country was forced to confront the harsh realities of an unregulated economy. The government, under President Franklin D. Roosevelt, responded with a series of bold reforms known as the New Deal. These weren't just temporary fixes, they were fundamental changes designed to prevent such a disaster from ever happening again. The era of laissez-faire, of letting the market run itself, was over. A key part of this new approach was creating a safety net for the American people and the financial system. The Securities and Exchange Commission, or SEC, was established in 1934 to police the stock market. Its job was to ensure transparency and fairness, to outlaw the kind of risky practices like manipulating stock prices that had contributed to the crash. The Glass-Steagall Act was passed to separate commercial banking from investment banking, preventing banks from gambling with their depositors' savings on the stock market, and the Federal Deposit Insurance Corporation, the FDIC, was created to insure bank deposits, so that if a bank failed, people wouldn't lose their life savings. For ordinary Americans, the lessons of the crash were personal and painful. A whole generation learned the hard way about the dangers of debt, speculation. They became more cautious with their money, valuing savings, valuing security, over the risky promise of getting rich quick. The experience forged a new sense of financial prudence that would last for decades. It taught us that stock prices can go down as well as up, and that borrowing heavily to invest is a gamble that can have devastating consequences. The crash underscored the timeless importance of diversification, long-term thinking, principles that remain the bedrock of sound financial advice to this day. Today, when we look back at the crash of 1929, we see a story of human nature, of hope turning into greed and greed turning into panic. But it is also, a story of resilience. It was a hard-won wisdom, a reminder that true prosperity is not built on speculation, but on a foundation of stability, fairness, and trust.